Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, June 7th, 4:51 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in a short-term uptrend since May 26th when we had a follow-through day that was our signal to dip some toes back into the water. And if you check over here at the trend gauge, we've seen some improvement since then. Leading stocks, we're pegging them as neutral, but with the green arrow pointing toward bullish/uptrend, as our 21/21 list seems to be holding up very well since we officially put it together last week. Short term, we are bullish and uptrend. All 5 of the major indexes that we track are above their short-term 21-day exponential moving average, and every test of this level on the big cap indexes certainly has held up, and sometimes poking its head below intraday, but right back above today. Today was a big test of that, especially on the NASDAQ 100, and we survived it with flying colors. Medium term, still showing bearish downtrend, but with the green arrow shooting in towards neutral, as we've seen some strength and some breaks above the 50-day moving average in small and mid caps. Long-term firmly in the bearish column below the 200-day moving average. We'll take a look at all these indexes shortly. So what just happened today? Opposite of yesterday. Yesterday we had a very strong gap up and faded badly. Today, an ugly gap down, but a strong positive reversal to the upside. So the gap down, when we look at the tail of the tape shortly, was caused by another warning out of Target that they're having all kind of inventory issues and going to have to take a bunch of inventory markdowns, and that initially hit all of retail, but most retail recovered by the end of the day, and Target made up most of its loss. So good news is bad news. When bad news is treated as good news or gets a positive reaction, we definitely want to note that. We saw that last week with Microsoft's warning also, as it initially gapped down and then finished higher. And then we had a Fed head, Lael Brainerd, talking negative, adding to the possibility, the hawkish possibility of September continuing rate increases into September, which hadn't really been discussed before. We had a move down on that, but it was nicely recovered. So when bad news is treated positively by price, it's certainly something to pay attention to. However, we cannot break through at this point the top of this 7-day range, and that's what we're going to focus on when we get to the chart. So very green on the day, G6, and this is something that's really jumping out to us. The G6 has been outperforming lately. When you combine today and tomorrow, it's the best performing of the indexes listed here, up 2%. S&P went from down 0.9% to up 0.95%. NASDAQ 100 gap down 1.1%, finished up 0.9%. Very good stuff there. Dow Jones Industrial Average opened down 0.8, finished up 0.8. Mid caps up 1.3. Russell gap down 0.8, finished up 1.6, as oils were extremely strong today, despite starting the day weak. 60/40 global stock and bond index up 0.57%. In-house GROTECTION up approximately 0.55%. We don't get more than half invested while we're below the 200-day moving average. That's kind of like a governor on a truck that keeps you from getting too far over your skis. So we'll limit our our volatility adjusted beta to a 1 while we're under the 200-day moving average, but that doesn't mean we can't make progress. In fact, we've made recovery highs today in the portfolios. So we'll get to the tail of the tape, and then we're going to review the G6 charts and review the portfolio. But first, let's get into a review of the faces here at Revere. Trend following is what we do. When the market's in an uptrend, we participate, get as long as we're comfortable, as long as the client is comfortable. When we go and start consolidating sideways, we pull back a little bit. When we are in a downtrend, which we have been for most of 2022, we get the heck out of the way. Those trends are across 3 different time frames. So you saw with the trend gauge at the beginning, we're always keeping our finger on the pulse of the short-term, medium-term, and long-term trends as and then we, depending on how strong they are, we invest accordingly. So if you're interested in this approach, please reach out to us. You can email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's get to the charts of the indexes here and blow it up just a bit so we can get a good look at the S&P 500 here. So it's not hard to see the 7-day range that I'm referring to here. Let's bring up the tail of the tape and get the exact levels. 7-day range from between 40.74 and 41.77. That's 2.5%. Once we bounced off the lows and broke through the bottom end of what was resistance. That was this 4070-ish level, really 4070 to 4100, and now the bottom of that range has been holding, so we flipped from resistance to support there, and we're battling next to try to get above this 4200 level. So between this 4070 and 4200 level has been capping the action for these last 7 days on the S&P 500, but we've got the 8, that's the thin purple line here, back up through the 21. We're coming into this downtrending 50-day moving average, only 1.7% away from it now, and that's going to be an important test for the indexes, certainly the large cap indexes. Small cap and medium cap, you'll see, mid cap, you'll see momentarily doing a little bit better. Let's go to the NASDAQ 100 now. Which usually leads up and it leads down. And leading down today was what we were concerned about. Let's go to a 5-minute chart here. Actually, let's go to a 15-minute chart here so we can see all 7 days. So what we did at the open was a gap down and then a little move down further, which undercut the lows of last week. Well, the lows of the end of last week, Wednesday and Thursday from last week in particular. But look how we did a slingshot right back up above those. That was extremely good news. Let's go to a 5-minute chart. I want to tell you something and explain what we did in-house today. So if you look at the 21-day moving average on here, it closed the day at 305.95. With the gap down, it was around 305.7. So we're looking to see if 305.7, which is approximately right here, was going to flip from what had been support to resistance. And the first move up failed. Then we hung around it for 3 more 5-minute bars, and then it looked like we were failing to break down below through it. So when we did that, we put on a hedge of the NASDAQ 100, a 5% QID hedge. No sooner did we put it on than we reversed strongly to the upside, blew through that level all the way up here to near 310, which had been another resistance and support level. Then we did a very nice intraday cup and handle. So note when we pulled back here, what did we do? We held this area that at the beginning of the day was resistance. We broke through it. When we pulled back here, that was the test that we needed to show that it was holding. And then we had a cup and handle breakout and then a pullback that tested the cup and handle again around 308, but again held it. So we held there, we held here, we held on the pullback, and we held on the back test. Those are all bullish things intraday. Now, if you look at yesterday, it was a mess. We just broke through levels, tried to reclaim them, broke down. But today, yesterday negative, today positive. This is very typical of what happens in bear market rallies. They can be harsh, but they're also choppy. And yesterday was a pretty choppy day. Today, we trended several times during the day, and resistance and support flipped at this level and flipped at this level. So we took half of the hedge off going into the close. Because now we're into the top, as you can see, if I bring up the 15-minute chart on the NASDAQ, we're into near the top of the range now, which for now is resistance. This 311, this 310, 311 area, all the way up to 313 is a resistance area. that we're in. So we could go a little bit higher. If we break out through it, fantastic. If we pull back to the bottom of the range, those will be two opportunities for us to get rid of the rest of the hedge, because either it's failing if we break through here, or it's holding if we come back down and test this 21-day moving average again. So see which direction we go after today. But again, this big 7-day range, and really what the market is probably waiting on is to see what the CPI numbers are this Friday. And then we've got the Fed next Wednesday. It's pretty much expected they're going to raise another 0.5%, but the inflation numbers are really what ultimately is going to kill or prop up this market. So big day on Friday with those. Let's take a look at the Dow Jones Industrial Average. Again, it's another one that you can see is chopping in this 7-day range. Let's go to the daily chart. Tested the 21-day moving average, bounced off of it, back up near the highs of its range around this 33,200 area. Not really showing relative strength, but that's okay, because typically that means that money is flowing from some more defensive areas into some growthy areas, and you're going to see that when we show the charts of the G6 momentarily. Let's go to mid caps, and looky here, mid caps, after failing twice in the last 4 sessions, was able to poke its head above the 50-day moving average today. 50-day moving average is still declining, so that's a negative. That's another reason why we haven't moved the arrow over to neutral, because the slope of the line counts. But for now, and again, look at we've had relative strength in mid caps going all the way back to 4.8. This has been a plus, or at least one of the green shoots that we were looking for in the market. When things are bleak, you look for reasons for the market to be positive. It doesn't ever go straight up or straight down. It's always a weight of the evidence. But today, good sign that we poked above the 50-day moving average on mid caps, and also on small caps, just barely poked its head above it, but did poke a bit. Note how those big cap indexes didn't get above the 7-day range, but we're making higher highs on the small cap index, and a lot of that is based on the fact that oils are extremely strong. When you see small and mid caps leading, very often it's because oils are putting in some outperformance, but we are coming into this 192-ish area that's going to be resistance on the Russell 2000. So those are the 5 major indexes. Let's take a look at the G6, and we'll discuss a reason why we've not been as bearish as some of the indexes are indicating. First of all, we own the 2 stocks that I'd always try to keep a Fab 5, and I don't know what the Fab 5 are going to be because we're still sorting it out, but it appears that 2 of them are going to be ON Semiconductor, which we own. Very nice consolidation day after a move above this range. Relative strength at a new high before price is always something you want to see. That's a sign of a leader. So ON Semi acting very well. We've got a 4% position on that, and LNTH, Lantheus Holdings, continues to just trend higher, riding this 8 EMA higher. Relative strength moving up near highs along with price. That's certainly good to see. It's got the fundamentals, big growth this year, slowing down a bit next year, but those are often revised up. But since this gap up on 224, when it got onto our radar, and then this harsh back test when it bounced off the 50-day moving average, and has been trending higher, and a relative strength leader since then. So those are 2 of the Fab 5. If you got some that you think I should put in the Fab 5, shoot me an email and tell me what you think, and I'll talk about them on Friday. But let's go to the G6 now. The first one is IWO. This is the growth half of the Russell 2000. Subtle uptick in relative strength, and again, above the 21-day moving average and staying above it. So whereas growth has had grossly underperformed going all the way back to November, you can see this downtrend in growth, just grinding lower. Well, it's stopped now. And for the first time in a long time, we're starting to trend higher. We did it very briefly here in February when the market had a little rally. We're doing it again, and this one, in this case, it was only about 3 weeks. Now we're on the 1, 2, 3, 4th week of it. So we're keeping an eye on it. We wanted to see what happens when these all come into their 50-day moving average. But as I scroll through the rest of these, you'll see a mixed bag here. So FFTY, the second component, this is the IBD 50 index. Again, note the relative strength here. This closed pretty much smack on its 50-day moving average. QQQJ holding its 21-day moving average, not really showing much relative strength here coming into the 50-day moving average. PDP, this has been the strongest of the six. You can see in its 4.5 weeks of relative strength here, and has had 4 closes now above the 50-day moving average, coming into resistance here around this 80 level, but the first one to get multiple closes above the 50-day moving average. ARK-K continues to just be, well, it's not garbage anymore. Note the relative strength line has been flat, so at least it's tracking the S&P 500 now on a relative basis, but fighting around this 21-day moving average, still well off its highs, and by far the most volatile of the 6. And finally, MDYG, also note relative strength for about 4 weeks on here. Did have some relative strength back here too, and closed above its 50-day moving average, coming into some resistance around 70. So we want to see continued strength out of this G6, and we want to see the big cap indexes get above their 50-day moving average. Those are the next things that we're going to be looking for. Let's go to the tail of the tape now. Not much has changed at the top of it here from a macro perspective. Sentiment, no extremes. We are operating under the bull case. You can see the green arrow here since we had that 526 follow through day and got us back above the 21-day exponential moving average. We'll flip from the bull case back to the bear case if the rally fails and we break the 21. That's what we were threatened with early in the day here on the gap down below the 21-day moving average on the NASDAQ 100. But buyers came in, and that's exactly what you want to see with weakness. So weakness being bought, but so far as we're capped, strength is being sold. So anytime you get to the top of the range, we're taking it off. Bottom of the range, we're buying it. We could do this for quite a while. Market will need a catalyst probably to break out of it, and that CPI number on Friday might do it. Or some Fed or some employment numbers. Who knows what it'll be, but looking for a breakout from this level. And then the next thing we have to overcome is this declining 50-day moving average on the S&P 500. So as I said, news target, it did open down 9%. By the close was only down 2%. They did warn again of inventory markdowns, but as I said, retail finished along with Target finished well off the lows. What we're watching coming in today is this same support and resistance areas, 4075 to 4100 on the downside. One that has been flipping back and forth between support and resistance at 4130, and then on the upside 4160 to 4200. The gap down held support, big positive there. Then we got back above the first resistance area at 4130 into the second resistance area at 4160. As that cup and handle breakout that I showed took us right up into that. Some notes, the QQQ, as I said, undercut and reclaimed the 21-day exponential moving average. This is our 7th day in this tight range. So looked like we may bust through the bottom of it this morning with the gap down, but no, but it did take us just back up near the top of it. So trying to bust it through this 4170 to 4200 area to get the next leg up and then challenge the 50-day moving average, which is at 4233. So lots of challenges ahead for the market. This overhead resistance is why we don't get too heavily invested, that and being under the 200-day moving average. So sectors that led today, bonds had a good day. Oils just chugged higher and higher all throughout the day. Steel strong, coal strong, XME the defense stocks strong, biotech strong. The only things that were weak, fertilizers and wheat. I mentioned how we hedged and then trimmed that QID position. But the bottom line right now for everything is a positive. Gap down 0.9%, reversed to positive 1% into the top of the range. So the rest of these areas here, I'll scroll down. You can pause if you want to see these other key areas that we're looking for overhead. their resistance, below their support. As we chug through one level up to the next level, we adjust our positions accordingly. So let's get into the rest of the things that we own here in the portfolio. VTIP, I didn't mention this on Friday when I did a portfolio review. This is a 5.5% yield short-term inflation-protected treasury that we're getting some price appreciation for it, and end of the month, I believe, we'll get a dividend from it also. So that certainly beating cash right now. TBT down today, but we're positive on this. This is just trending above the ADMA. This is, as interest rates go up, this goes up. So it's the opposite of bond prices. Recall the typical 60-40 portfolio would have you in stocks, which are downtrending, and in bonds, which are supposed to cushion the blow, but they're cushioning the blow by going down lower on a relative basis, and they're under the 200-day moving average. That's why we've owned no bonds in-house for quite a while. As interest rates trudged higher, that means the price of bonds goes lower, which means the value in your portfolio goes lower if you're in bonds, and that's why we're avoiding them. In fact, we're doing the direct opposite by being in TBT. If you look at TLT here, this is near recent lows. If you look at TNX, this is the 10-year. This is the yield, and it's up near approaching highs. So this chart pretty much mirrors the chart of TBT, which is goes higher with rates as opposed to the price. So GLD, we're still about flat on this as this chops around in this area, which is really, I think, the equivalent of around 1850 on a gold chart, holding the 200-day moving average, but not making any progress really up or down. But on a relative basis, you can see the relative strength here trending higher on gold versus the indexes. ON Semiconductor had a nice move up yesterday as it was added to the S&P 500 inside day today. I already showed the chart of that. Also showed LNTH. Those are really what I consider two of the top stocks in the market right now. We also own ZIM. Shipping stocks continue to be strong. We're going to get our 4.1% dividend paid out tomorrow into the accounts on this that was declared a week and a half ago. And then we own two oil stocks, LNG, real nice day today, up 4.5%, near all-time highs, and also Chevron CVX, near all-time highs. All five of those stocks we have 4% positions in. In addition, we have a 10% position in SSO. We'll have that as long as we're riding above this 21-day moving average and we don't get rejected by the 50-day moving average. And then we also have, we own DIA, a 10% position in this. And then I mentioned the QID short that we have, and that's our full portfolio for now. Adjusted beta level 0.90. As I mentioned, we typically don't go above 1 as long as we're below the 200-day and the 50-day moving averages. That's going to wrap it. If you have any questions, as always, love to hear from you. Email me, don@revereasset.com, or you can phone us at 855-REAL-WEALTH. So wrapping up Tuesday, June 7th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.